How would you frame the new administration and maybe the impacts, pro and con, that it could have to our real estate investing space?
I mean, there's just massive change going on. And I think right now, we don't necessarily know how a lot of these changes are going to turn out. And so I think that will keep more capital on the sidelines as they try to figure that out.
It's my great pleasure to welcome you to 2025. A new year, new administration, and Counting Capital is now entering into its third year of production. And it's a great treat for me to bring back my first guest, who's been my business partner now for over 30 years. You all know Tim Ballard. He's our president, our CEO. And since the inception of our business now over 25 years ago, we've completed $8 billion of real estate debt and equity transactions. And we're going to cover a wide range of topics today, which I'm looking forward to as we talk about our investment business. We'll talk about the capital markets, and we'll talk about a little bit about today's market opportunities and Buchanan Street going forward. So welcome, Tim. This will be fun. We did this a while ago. It seems like we talk about this stuff daily in the office, but I think it'll be great to bring it forward to our clients and those interested listeners. So maybe we could kind of start by having you frame a little bit about how has the real estate industry changed to when you got into the business? And I'm a bit older than you, but you started your real estate career when?
In 1989, although my first real estate investment was probably 1986. So I have always been interested in it, but now with this question, you're going to make us both look really old.
There you go. Me older.
I think you use slide rules and abacuses and stone chisels. But I remember my first job, all of the senior people didn't have computers. They had dictaphones that they would tape letters to their secretaries who would then type them for them. And so only the junior people had computers, and those computers were pretty archaic. I mean, there was no internet. There was, it was basically for word processing. And so the dynamics of the business it's just amazing how much it has changed. We've gone from a very simple industry, very inefficient business, a business that really didn't have access to great data. Like if you want to figure out the value of a building or rents for a building, you'd call up people and you'd say, hey, how much does your building rent for? And they'd tell you a number. You couldn't get any research on it. But you'd say, how occupied is your building? And maybe you got the right answer, you didn't. And so in the scheme of things, if you look back, so in 1989, the entire size of the public markets for REITs, equity REITs in the United States was $5.6 billion. And so if you think about that, our little company's done more business in its history than the entire size of the REIT industry when I got into the business. And today that's, dramatically different. The, equity values of domestic REITs are like $1.4 trillion today. And with that, that's brought all sorts of capital from around the world, sophistication, educated employee base, et cetera. It's a night and day difference in the business.
Yes, well, I think that's a good start to having folks understand kind of where we are today and why capital flows have increased and why there's much more predictability, and the asset class has grown within the alternatives investment bucket, if you will, for investors. So I consider Buchanan a very entrepreneurial-led investment firm. So as you think about entrepreneurial spirit and that approach to building a business within this evolving real estate market to where it is today, and I think you framed it well as its evolution, how has that advantaged Buchanan Street in its evolution, kind of that entrepreneurial approach to this business?
Yeah, well, I think to be an entrepreneur, you have to have a few traits. One of them is you have to be probably a little dumb because you're willing to take enormous challenges on without really fully understanding them. You have to be really convicted about what you're going to do because otherwise you're just not going to do it. And with that, I think, comes some stubbornness. So you have to be willing to overcome challenges, learn, ask the question why every day. And I think both you and I are built that way. We like to learn. We don't have fear of the unknown, and that's allowed us to, build a interesting business that I think it's served our investors very well. And part of that is, if you think about it, is part of being a good investor is about not going with the flow. There are lots of days where everybody's excited about making investments. Valuations are very high. You have tremendous pressure from your investors to put out capital because they have those same views. And then, but you have to say to yourself, well, does that really make sense? And so sometimes it just doesn't make sense. And you say, no, I'm not willing to invest today. And conversely, there are times like today where the markets are a bit more challenging. And your conviction to do stuff may come in the face of investors that are less interested in deploying capital today, in the face of kind of bad news in the marketplace. And so what we've done historically is, I think, done a good job of not pushing all of our chips onto the table when everybody else was, and then when times were tougher, is holding true to our convictions and making those investments when people had more fear.
So I like the frame of the entrepreneur, and I want to bring to life this a bit more because I think it's telling with what we're doing today. As I think about pivots, if you will, that we have made, led by that entrepreneurial kind of DNA that we both have. So I think about maybe when we started our business, we were much more geared with the institutional investors that we represented. Today, we're much more geared with high net worth families, registered investment advisors, and family offices. So bring to life that pivot and why that took place.
That's a great question, Robert. And as I think about it, is we've had a long history with very large institutional investors that have been great to us. Having said that, I think as being an institutional investor, one of the things that is very important and part of their DNA is they invest in strategies and firms that are large, that have long track records in whatever they're doing. And one of the things that we've done as a firm is innovate. So if we come up with a new idea, it's not necessarily a great fit for the institutional investor because they're going to want to say, well, tell me about the last 10 years of your track record doing those things. And conversely, with a high net worth investor, they make more of their decisions on who are the people. Do I trust these people? Do I think they're smart? And are they going to make good decisions in these new things that you might do? And that has been very helpful given the kind of evolution of the strategies that we've been involved with. And I think about, office as an example. We haven't been an active office investor for, probably 8 years. And that was in the time frame where people were dumping enormous amounts of capital into that space. And our institutional investors really wanted us to invest in more office buildings. In hindsight, buying an office building in the last 7-8 years was probably about the worst idea you could have ever had. And we didn't really do that. And so the other thing I think that's important is I think if you do a good job for a family, and you continue to do a good job for a family, you have a relationship for life. And that's something that's really important to the success of our firm, is all the relationships we have that we can depend on to manage their capital.
Yeah, excellent. I'm glad you hit upon that. And that is something we're prideful of, and we're very relationally geared. So I would agree with you. So I think as we're, in the new year here, we're not a political show, but we'd be remiss to not talk about the new administration and a lot of change going on right now. And I think change can cause a lot of apprehension and worry for most. And if you're an investor, wanting to see how the landscape settles is important. So how would you frame the new administration and maybe the impacts, pro and con, that it could have to our real estate investing space? You and I talk about this often, but give our listenership kind of a foundational sense for that from your perspective.
Sure. That's a great question and very topical. I think if you look at what's happening, if you just look at the news, the best way I think you can describe it is it's frenetic. There's just massive, massive change going on, whether you like it or not. There's change afoot. And so I think there's a lot of good things in terms of, cutting wasteful spending. There are a lot of other things that we just don't know what the outcome may be. And so what I mean by that is, hey, let's tariff, the rest of the world. Well, the rest of the world we depend on for a lot of things in the real estate industry, like building materials, whether it's lumber from Canada, whether it's plumbing supplies from China, whether it's drywall, whatever it is. There's a lot of this stuff we import, and could have significant effects on the cost of those goods. There's also the part about uncertainty, and so investors who are going to buy a piece of real estate or a company are making an investment for the very long term, and people do that when they have confidence about the future. And I think right now, we don't necessarily know how a lot of these changes are going to turn out. And so I think that will keep more capital on the sidelines as they try to figure that out. Having said that, I can make an argument for, if we bring significant efficiency to our government, if we cut spending by $1 trillion and have those assets deployed into the private sector more efficiently, have a need for less borrowing at the federal level, I think you could argue that we'll have more buyers of our treasuries, and that could bring long-term rates down, which has a very significant positive effect on hard assets like real estate.
Yeah, I'm glad you mentioned the rates, because our industry is a very levered asset class, and as such, most borrowers and most calculations of returns are predicated on that leverage. So now let's kind of move forward to talk about opportunities that we see in the market today, brought on by this volatility, this change, which for many is very hard for them to kind of run their businesses that way. But I think you and I have found in these times that their opportunities exist.
Yeah, I would back up a little bit and just reflect on what we've really seen over the last 5 years. So, we had a pandemic. Nobody knew how that was going to turn out. The world shut down. Interest rates went to zero. As it became clear that we would all get through it, and interest rates remained at zero, investors were desperate to deploy capital at something other than zero. So there was massive capital flows into everything, including commercial real estate lending, and investors, whether they were qualified or not, or investment managers, whether they were qualified or not, could raise billions of dollars of capital and deploy it. And so if you look at, kind of mid 2022, cap rates on Class A apartment buildings in the United States were 3.5%. A lot of investors bought those apartment buildings at that rates, and very similar for industrial, across the spectrum, cap rates are very low. Well, with the rise of interest rates and the inability of some of these investors to play through on their business plans, what we've seen is a massive rise. I mean, a very historic rise in cap rates, which have resulted in massive valuation declines across the spectrum. And so today, if you look at kind of Class A apartments, that's more like a 5 cap. And so if you do the math, that's essentially a 50% decline in the valuation attributable to the cap rate. Having said that, we've had some rent growth that through 22, 23, but that really disappeared in 24, and even negative in some markets. And so what you should take away from that is if you have a 50% decline in the valuation of an asset you bought in 22, and you borrowed 50%, you've lost 100% of your equity. And so this is the environment that we've gone through. And so there's lots of investors who have distress, whether they've disclosed it or not. There are a lot of lenders who have very impacted balance sheets because they made loans based on these high valuations that have gone down. And so what that's really done is caused the transactional markets to really lock up. I mean, transactional activity is 50% of what it was 2 years ago. And with that, investors are cautious. So what I would tell you today is whether you're an investor, you're cautious because you have issues in your own portfolio, or you're waiting around for the distressed assets to come to market, or you just don't want to be the first one in. It's a capital constrained market. And so I really like to invest in places where there aren't, it just isn't flush with capital. By definition, you're going to get a better buy. And I think you have to be careful about what you buy. But this environment today, I think, is one we're going to look back on and wish we invested more.
So great setup and backdrop for kind of my next question for you and helping our listenership understand what we do and what we do today. So with that backdrop, what are the investment strategies that Buchanan is deploying today to take advantage of this new world, if you will?
Sure. We have two kinds of strategies. We're both a debt investor and an equity investor. And in our debt investing, we make bridge and construction loans on transitional assets where we think we can earn equity-like returns in that space, but having a significant level of subordination of borrowers' equity to our position. The second place we invest is in equity, and I broadly break that into two different kinds of strategies. One is buy kind of core plus assets that we're willing to hold permanently. And these today that has been historically a lot of apartment assets that we think are inflation protected. And so in those assets, we're assuming that we're going to get kind of half of our return from cash flow, and then the other half of our return from appreciation in the value of that asset. So these are safe assets with lower leverage that we think are good foundations for people's portfolio as a diversifier. And then the second component of our equity investing is really situational investing, where we're just looking for opportunities where we think there are outsized returns, whether we have a different strategy, we buy an asset that's mispriced, there's just a situation that allows us to capitalize on the what's going on and create extra value for our investors.
Tim, I think that investors get confused at times about returns and the risk that you take on for that return, and maybe unaware of unlevered versus levered returns. So can you help us bracket that a little bit from a risk return standpoint as you just kind of describe what we're doing? Because all returns are not equal. And I do think there are some people that are probably taking on more risk than the return warrants. So help us understand a little bit about returns.
That's a great question. One of the things that I think it leads me to think about is a lot of investors, I think, fool themselves in terms of investment returns. I mean, if you really look at it, real estate is a long-term asset. It should yield, on an unlevered basis, maybe 300 basis points more than treasuries, plus or minus. And then you add some leverage to that, and maybe you pick up another couple hundred basis points. So real estate's should be a 7, 8, 9% unlevered asset, and maybe it's a 9, 10, 11% levered asset. What people I see routinely I'll have investors call me about, hey, I'm thinking of making an investment in this deal with somebody, at my country club, and he tells me it's a 23% IRR. And then you start asking some questions, and what you realize is that you can make a investment say whatever you want. If you make a cap rate 4% on everything's going to be a 20 IRR. If you make rent growth 8%, every one of your investments is going to work out. And so I think a lot of people fool themselves in that they're not professional real estate investors, and so what they just look to is what whoever's talking to them is telling them in terms of what the returns will be, and consistently. General partners, investment managers are overly optimistic about what they tell investors are the outcomes. And along with it, in terms of your question, I think it's a great one from you really have to understand the risk you're taking. So there's a bunch of risks in real estate that people, I think, need to pay more attention to. Some of that is, well, who are you investing with? And so you might have a great property, a great business plan, but if the general partner, investment manager doesn't have the ability to get there, it doesn't matter what the project is. So I think people should spend as much time looking at who they're investing with as they are looking at what that investment is. The other things, like whether it's construction is can be especially risky if you're not really skilled at doing it. Entitlement is remarkably risky and something that's not very controllable as the investment manager. I mean, so there's lots of these kinds of risks that if you invest in them, should get paid very well, but also expect they're not all going to turn out that way.
So that's helpful. And you and I, being within the industry, have always kind of bracketed that risk into buckets of kind of core value and opportunity. So does Buchanan do participate in all those kind of ranges of strategy and risk profile?
We do. And, kind of to bracket those, how, if you think of core, that's a super high quality asset in a gateway city kind of location without leverage that might earn 7-8% kind of return. Core plus, maybe you get to the 9, 10, 11%. And then when you talk about opportunistic, it really depends on the strategy. I think if you're doing speculative development, that's going to be a high teens plus return. And what's interesting about it today is getting back to one of your earlier questions, is there's a lot of people that have capital. I mean, there's tremendous dry powder on the sidelines. But what you hear from people is, yeah, I'd like to make an investment, but I'd like to buy things with very little risk, and I want to make an 18% net return to the investor. And you're like, well, that doesn't exist. And so you're really not, although you have a lot of capital, you're not deploying it because the assumptions you're making in terms of the return requirements are just out of market.
So Tim, we have predominantly been an equity investor, but we got into the lending business, the debt space. And so how do you view risk return there? And maybe you can just comment on why we also make loans in addition to owning and operating properties.
Yeah, it's different kind of risk. One of the things that we decided to do, probably 12, 13, 14 years ago was in the equity space, we saw having, investing as an LP investor with third-party operators was an additional risk. It could be a benefit, but it was an additional risk to our equation. So what we decided in that space is do things that we can control the outcomes for. And so we, as an equity investor, really invest in things that we are the general partner. We're the ones who are controlling the outcomes of that business plan. In the debt space, that's different. I mean, you're lending money to a borrower. You're not in control of that. And so what we decided in kind of making that entree into that space is, well, we can do that if we have significant equity subordination. So, we're making really a trade for not having control by having a borrower that, may have 25, 35% equity subordination to us. And so take some of that volatility off the table. And what we found is that over time, as an example, the bank lending market, sometimes they're aggressive, sometimes they're not. Today, banks are not aggressive. I mean, it's, a typical loan that we might get from a bank is 55% on super safe assets. And so a lot of people today are shut out of the bank lending space. And so we really provide kind of that gap capital when markets are inefficient and get paid very well for it.
That's helpful, and I know it's been an active activity for us. And I think about leverage in general and borrowing as an operator, and the lack of predictability of kind of the debt markets. How do you and how do we factor in leverage and that cost of leverage as we look at making an equity investment today, given that many of the investments require leverage to complete?
Well, I view leverage as one of the biggest risks in real estate investing. And I remember we had a conference once where we had Michael Milken speak, who, he's the kind of inventor of the junk bond market. And he made a really interesting statement. He said, a lot of investors view getting more leverage as a positive attribute of a transaction. And what he said is, it isn't. It just makes it riskier. And so, there are a lot of investors who find themselves unable to play through their business plan because they have debt that comes due. They don't have adequate capital to deal with that debt maturity. And as I look at our business, we borrow very conservatively. We borrow from relationship lenders that we've had a long-term, borrowing relationship, deposit relationship, et cetera, at pretty low levels compared to a lot of how the rest of the market borrows. And I always want to be able to, play through the investment. What I mean by that is, if you borrow the last dollar every day, there's some days that you have to pay your loan down by 30%. And unless you have that kind of liquidity, you can't do it. And your lender says, well, too bad, pay me off, and you don't get to the other side. And so if we borrow 50, 55% and things don't go as we thought, because you have a pandemic, you have some unforeseen event, the banking market changes, you at least have the ability to have a conversation with your lender, refinance it in the marketplace somewhere else, because you still have significant equity left in that transaction. And so that served us well. I'm happy to say, when I talk to investors today, one of their frustrations is they have lots of funds that they've invested in, assets that they've invested in, that they're getting capital calls every day to deal with their debt. We've never made a capital call for investors to pay down our debt.
So helpful, for the listener to understand just the predominance of banks in the real estate lending business. But that has really changed a bit. Banks are lending less or not lending as they kind of rebalance their balance sheets. So there's been kind of this evolution of private credit. And obviously we're participating in that at some level with what we're doing with our own lending space. But is that just for the short run, or is that there's some permanence that's going to happen with the private credit player within our real estate business?
Yeah, I believe there's permanence in it. It's just like, the beginning of this conversation, we talked about the evolution of the real estate equity business. So, real estate equity business was inefficient, became very efficient with lots of institutional capital. If you went back into the early 90s, late 80s, primary sources of capital for lending in the United States were S&Ls and banks. Now that's just, you have a plethora of types of investors who will make loans, whether it's debt fund vehicles, insurance companies, banks, foreign investors. And so I think it's just the continued efficient market of people who are going to find opportunities to invest capital. One of the things that I think what I think should happen is banks should make safe, lower leverage investments. Their balance sheets bank balance sheets are very leveraged. They rely on the FDIC for insurance, insuring their deposits. And based on those factors, I think they should make very safe investments. And, equity investors who, invest in debt funds are taking a different risk. And I think that should be the home of kind of riskier types of lending opportunities. The thing I would caution people of is, there's hundreds of debt funds focused on real estate today. And I'm quite confident that lots of them have not lived through economic cycles. Lots of them haven't dealt with distress. They're dealing with it now. So I just be careful, again, it's about, making an investment is as much about who you invest with, their history, who they are, versus what the idea is. And so there's a lot of folks out there that maybe don't have the experience to figure out the kinds of things they're investing in.
So that's a good point. I think it was not lost on a lot of our foundational investors in our lending business, just that we have such a rich background and an ongoing activity within a running real estate side. They clearly understood that in the event that we have to take an asset back or there's a problem with an asset, that we have that core competency to run that real estate. So that's a good observation. As I think about, you mentioned you started in the business in 1989 and we were young guys. And I think your average investor would have a portfolio construction, if you could think about it, maybe 40% equity, 40% fixed income of some sort, and maybe the rest cash. You look at a standard asset allocation for a high net worth investor today, and it's quite a bit different. And really that's predicated and happened because of the emergence and the predictability of alts. So how does real estate in your mind fit into an investor's portfolio, or should it today within that alternatives allocation, if you will?
Well, real estate is uh, a fantastic asset class for a variety of reasons. I think, initially, the institutional investor said, "Hey, it's a good diversifier to the other types of assets they own. It lowers the volatility of kind of returns and makes for a more efficient portfolio." So I think that's what they decided. And then when you kind of look and bring it to the private, taxable investor, the high net worth investor, there's enormous tax benefits that accrue to real estate. And so what I think is really important is beyond the correlation and diversification benefits you get in inflation, potential protection from real estate is it's one of the most tax efficient types of investments a high net worth investor can make. And so ultimately, I think what the investor should be concerned with is, how much is left over after I pay the government? And so, we have lots of tools to minimize taxes in commercial real estate investing.
And I think you can color this a bit, but I think the asset classes perform much more predictably from an income generation standpoint. And the liquidity that people might think they need within their alternatives portfolio hasn't been as much of a priority given their other asset classes or their ability to withstand the illiquidity component of most real estate that you invest in.
Yeah. So, if I look back, it's kind of interesting whether it's in our self storage business or our multifamily business. I do this, quarterly. I look at, what did we think? How did we think we would do versus how we would do? And so, I look back on in these investments that, if you look back over the last 5, 7 years, you've had pandemic, you've had zero interest rates, you've had flood of capital, you've had inflation and rent. You've had rates go up, nobody moves. All these just different kind of whipsaw of things that would affect your demand, your expenses, your cost of capital, all of these things. And then I look at how we've performed, and in our both in our self storage business and our multifamily business, our net income that we've generated. Over the life of the investments in our portfolio is, I think we might be, 98 to 99% of what we pro formed initially, which is just, kind of remarkable when you think of just all of the changes that have gone on over the life of that portfolio.
Yeah, I think that's a good example for everyone. I think about the future, and you and I still love coming to work. We have a growing percentage of our own net worths invested in Buchanan activities. We like having a platform to continue to make investments side by side with our investors. Help us understand, predict out kind of Buchanan Street 5 years from today.
It's an interesting question, and there's things that I know will be the same. So we've built a firm based on a set of values, and those won't change. Having said that, what we do every day has evolved, because I think, one of the things that's made us great is we try to figure out what the best thing to do, what is the smart thing to do, and how do we use our resources and tools to take advantage of that. And so, if you went back 10 years ago, we had a very large office portfolio, and we made decent money doing that. At some point in time, we decided that's not like the best use of our capital, and there's other things that we can do. So I think we'll continue to look to innovate, discover the things that are best for our investors. I would like to believe that we can double the size of our AUM, and we'll do that from attracting and retaining great talent that kind of aligns with our mission and values. One of the things I think is exciting about what we do is you alluded to this, which is we have about $60 million of co-investment alongside of our investors, and so part of what's fun about coming to work is it's the opportunity to manage our own capital, and we do that in great alignment with our investors.
Yeah, I think that's well said. And mindful of our schedule today, I wanted to, as we wrap with a couple of last questions, if you were to kind of message to your clients, your listeners, the life learners, kind of what you would want them to know about Buchanan and how we work on their behalf, what are some messages or some touch points you would want to leave them with?
As I think about that is what differentiates us. And, we're always asking the question of why and how, versus, someone said this was a good idea. Why is that a good idea? Why should we do this? Why are we going to be able to lease it for this? How do we deliver a better experience for our tenant? What does the, industrial user need out of a space? How do we make this better for their business? And so we're always, both of you and I, whether it's in our business or our personal lives, I think just want to know how do we be a better husband? How do we be a better father? How do we be a better business person? And so I think that's a super important part that translates into our work. Is it's because we did something way yesterday doesn't mean it's the best way to do it, and we're always willing to kind of challenge ourselves on how do we do it better.
Yeah, I like that. I like that way you kind of analogize that. I would think about, the people ask me, well, so what do you do in your role today, Robert, as chairman? And I say, well, I like to visit the sites. I actually touch the real estate that we invest in. And they say, you actually drive down or go and visit? And I said, yeah, that's what real estate is. It's a very hands-on hard asset business. And I think about the investment we just made in Class A apartments down in San Diego as a construction lender, and thoroughly enjoy that kind of market analysis. So I think you and I often talk about how decisions get made at Buchanan with senior people involved in all of those decisions. And that's not necessarily true for every organization in real estate today. So I think that's just the way you and I like to work. Again, having our hands on it very actively. So that kind of brings me to my last question before I just have some general comments. You, Chris, and I, Chris McDonald, who really is instrumental in leading our high net worth and RIA practice, have been partners now for over 30 years. And if you were to kind of comment on what you would attribute the success of this long-term partnership, which is very unusual in business, what might you speak to in that regard?
Well, it's a bunch of things. I think there's the easier things to talk about, which is, we have different skill sets. We have different passions. I think we've all said, hey, Robert's more passionate about this. Let's defer to him on that. Ballard's, more passionate about this. Let's let him run with it. And so I think that's been very helpful. But I also think, when we get back to a discussion about values is, there's a lot of folks that are, very focused and certainly in business on just, hey, what do I get out of it? And I think what we've been focused on is how do we build a great company? How do we build things for the long term, and not necessarily focused on what's happening today or what is the outcome today, but how do we do this for, a long period of time, which is, allows you to make a very different decision. I think, the desire to build something great has far outweighed the desire of like, what do I get out of it or what do you get out of it today? And that makes you make better decisions.
Yeah, I was just writing myself a note. I think I would say to that also, we have the same principles, same values. We also, most importantly, have the same views on risk return, which I think 95% of the time has really led us to consistency of agreement on those investments we do make. And then I think there's also a large part we enjoy one another's company, the great friendship. So I think they're very important as you have your business partners for life in that regard. So last maybe quick question. We have a lot of younger people I'm learning that enjoy listening to the podcast, our Counting Capital discussions. So what might you provide as a touch point for a young person that's starting their business career and maybe wants to get into real estate or just thinking about what is the right career for them? What advice might you offer?
You touched on one thing before I answer that question that I think is really important, which is You and I are very conservative guys ultimately. I mean, you think about, how we invest outside of Buchanan, how we use leverage. Neither of us use really any leverage, or very, very modest leverage. And I think what's really important, in terms of whether it's our investor, how we look at the world, is you have to look at both the upside and the downside. Lots of investors just look at the upside and they never get to it because they didn't plan for the downside of what happens over long periods of time. And so, as I think about young people, you know, there are the things that are going to make you successful is you got to put in the work. You got to work really hard. You got to play for the long term. And if you put in the effort, you make good decisions, you are an ethical person, a person of character, this business has, magnificent opportunities for people that are willing to do that. Ultimately, there are a lot of things, there are a lot of industries, I think, that are going to be heavily impacted by AI. I think that will be true of the real estate industry. But as of today, this is an industry that also is heavily reliant on the relationships you have with people. Go build those relationships because they'll serve you well over the long term.
Perfectly said. Well, you and I could do this for hours, and we do this daily, but it's fun to kind of do this on the pod. And I hope our listenership of Counting Capital has enjoyed this. And we'll have you back, but we won't wait another 2 years for it. And I no doubt we provided some good take-home value, but I think about one of the things that we pride ourselves on is to provide thought leadership. And it's whether it's through our chairman minutes or these podcasts or just writings that you have with our investors. I'm hopeful that this is not lost on them, that how we look at the big picture. And then this is an unprecedented time of change in our world. And I think to know that there's good stewards of capital and to have people at least for us to provide the transparency of our values, our strategies, and our outcomes is, I think, very valuable. So, Tim, I want to thank you for your time this morning and thank all of our listenership. And we'll look forward to seeing you on the next program and the next Counting Capital podcast. So thank you, everyone.
Thank you for joining us on this episode of the Counting Capital podcast. For informational purposes only and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.